Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, April 16th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is correction or crash, plus China's March activity data supports our China front-loading stimulus theme. So the nuance there is China's retail sales and industrial production both slowed and missed consensus estimates, while deflation deepened in the property sector in price and investment terms. The market implications there. So to answer the correction or crash question, we must consult our first principles framework, which concludes the stock market only crashes for one or more of the following three reasons. Number one, a sharp, unexpected, and protracted deceleration in growth. Number two, a sharp, unexpected, and protracted acceleration in inflation. And number three, a sharp, unexpected, and protracted tightening of monetary and or fiscal policy, usually monetary policy. So we see neither outcome as likely over the medium term. Elsewhere, we still view the Chinese economy as being on unstable footing and not on track to meet the government's 8% nominal GDP target for 2024, an outcome that requires incremental policy support. So transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This question reads, it's about the correlation of KISS portfolio assets. So a high skipper, when inflation is higher than 3%, bonds lose a diversification benefit as they become positively correlated to stocks and therefore increase portfolio risk. This is one of the key conclusions from our fourth turning investing during the fourth turning regime analysis. So they're spinning that back at me. So additionally, Bitcoin proved to be not a crisis hedge over the weekend and behaved like a high beta risk asset. Seems like the positive correlations of portfolio assets would matter in a fourth turning where geopolitical tensions are likely to remain higher than the previous decade and inflation is likely to be sticky and average higher than 2 to 3% in the next decade. How do you view the potential positive correlations of the three ETFs in the KISS portfolio construction? Is that a feature? Is that a bug? Or are you neutral? Do you pay attention to it? And does it matter? So phenomenal question, by the way. This is the kind of institutional question that I spend all day, responding to our institutional clients on and helping them build and construct portfolios and strategies, for them in our portfolio client meeting. So high-end question, very, very thoughtful. So I'll kind of address this kind of in order. One, Bitcoin is not a crisis hedge. It's never been a crisis hedge. So please get that out of your brain. That's something you're going to learn on crypto Twitter or finance Twitter. But the reality is, in actual risk management terms, Bitcoin is probably the exact opposite of the crisis hedge. This is an asset that is proven to lose 50 to 90% of its value every 4 years. So just be aware of that. So if you're thinking about Bitcoin as a fourth turning crisis hedge, it is from a longer term perspective. But whenever you're in a risk off market regime, you're talking about an asset that has a significant left tail to it that you need to risk manage. And obviously, that's what we do in terms of the KISS portfolio construction process. It's helping you maximize upside capture in Bitcoin bull markets and minimize downside capture in Bitcoin bear markets. And obviously, we do that across all the major asset classes in KISS, stocks, bonds, and crypto. And so getting back into the question here. So in terms of thinking about this from a portfolio construction standpoint, all assets are going to be generally positively correlated. That's just the way of the world. Populations grow, money grows, money supply grows, and asset prices grow over time. Those things are all positively co-integrated over long periods of time. They may not be positively correlated on a short time interval, but over a long period of time, those things are all be positively correlated or co-integrated alongside global liquidity. So that's number two. And then lastly, number three is the fact that we are in this sort of higher inflation regime in which stocks and bonds are positively correlated. Is that something that's a feature or a bug of KISS? The reality is it's neither. It's neutral. So there's sort of multiple ways in which investors on the institutional side think about managing risk from the perspective of constructing portfolios. The primary tool that a lot of investors use in that sphere is diversification and true diversification, where you have an asset portfolio of uncorrelated assets. Obviously there's kind of false diversification where I'm long small cap stocks and then I'm going to diversify into mid cap stocks. I'm going to further diversify into large cap stocks. That's false diversification. Those things will all be highly correlated in any market drawdown. But true diversification is finding uncorrelated assets and striking those both across time and catalyst within your portfolio. So that's one way institutional investors think about managing portfolio risk. The way in which we've chosen to implement within the context of our KISS portfolio construction process is actually trend following. And the reason we've chosen trend following over true diversification, one, it's harder and harder to find assets that are truly orthogonal and uncorrelated. That's something that's very difficult to do. And obviously, a lot of folks who think they're diversified generally find out that they're not very diversified in a market crash. So that's an issue. And then number two, trend following has proven to be a much more a powerful and stable driver of outperformance for most portfolios over time, particularly whenever inflation is elevated. And so you go back to the 70s, the number one strategy that worked back in the 70s was trend following. That I've seen papers from like the Man Group that try to replicate trend following strategies for like the 1940s, and trend following was a dominant strategy in that period as well. So, we've elected to infuse trend following elements into our KISS portfolio construction process as guiding the top-down risk management overlay, which infuses vol targeting into the assets, and then the bottom-up risk management overlay, which infuses dynamic position sizing into that process. And the confluence of those two processes are the reasons why KISS helps investors maximize upside capture in bull markets and minimize downside capture in bear markets. This is why, generally speaking, KISS makes money, books gains, makes money, book gains. What a lot of investors are doing is make money, give half of the gains or more of the gains back, make money, give half or more of the gains back. And that's obviously not a process that is repeatable, and certainly not going to be one that helps you achieve your strategic investment objectives. And which I'll conclude by saying, if you are a retail investor, if you're an investment advisor servicing retail investors, your only strategic investment objective should be to retire on time and comfortably. That's it. Retire on time and comfortably. Retire on time and comfortably. Your strategic investment objectives should not be, I'm going to game dealer gamma positioning today so that I can figure out where the S&P is going to be tomorrow. That's preposterous. Do not do that. Retire on time and comfortably, and that's what we built our KISS portfolio construction process to do, is to help retail and investment advisor clients retire on time and comfortably. That's it. So wrapping up there, Darius Dale presenting our macro minute for Tuesday, April 16th, 2024. Everyone have a wonderful day out there. Best of luck, and we will catch you back here tomorrow. Cheers.